I've been in microfinance for the last 15 years, having started my journey from Micro Kenya, a credit-only institution that was giving loans to formerly employed people and deducted over a period of a maximum of 12 months. And this came out of the realization that consumer lending was lacking in Kenya. That was in 2000. And we started by giving loans to salary people in institutions where we would sign memorandum of understanding for check-off or deduction at source. This business really picked up. But come 2002, when the interest rates came down, all the banks and all the financial institutions came for that market also, because they realized that as much as it had risks in the sense that it was not secured, it also had a lot of opportunities because these people were not losing their jobs every day, meaning that actually it was a very stable portfolio. During that time also, we asked ourselves as an institution, do we want to diversify our products? And we diversified into business lending. And that brought up Micro Kenya being now an institution that lend both for consumer and at the same time to business, or what I call small and medium enterprises. This gave us the appetite now to roll out across the region. And at that point, we rolled out in Uganda, we rolled out into Rwanda, and felt that for sure the products were fitting in the market that we wanted to get involved in. And that gave us even more appetite to buy a microfinance company in Uganda called Uganda Microfinance Limited, together with support of some development funders. Uganda Microfinance Limited, which is currently Equity Bank Uganda. So what happened is that we asked ourselves as an institution, what is it that we want to achieve? And we said we hadn't achieved what we wanted, because after we sold to Equity Bank, they converted it into a bank.
They renamed it.
They converted it from a deposit-taking microfinance institution into a bank. And we felt that there still exists a very strong business at the micro level, which can be served at a microfinance level and not at a bank level. And that is the reason why we sat down and said we want to continue with the model that we had put across Kenya, Uganda, Tanzania, of microfinance institutions, focusing at the lower end, but not going too low, where the cost of delivery is very high because which is managed by the NGOs. And we changed our name from Micro Kenya to Micro Africa, so that we can have a footprint across some specific countries that we are targeting in Africa. That was in 2009. We changed our name to Micro Africa and consolidated our positions in Kenya, in Tanzania, in Rwanda, and South Sudan.
So in 2000,
by building that kind of a business, we were sure that the clientele that we're dealing with is a clientele that we're used to.
correct.
Because across the region. And then we also realized that it was much cheaper for us to operate in the region, because there was a lot of commonality across the populations in this region. So our product development was much cheaper. Our technology was much, because we are using a technology across, all the banking software is across. To replicate became much cheaper, and we thought that that model was actually going to work. But at that particular time, 3 of our principal shareholders, institutional shareholders, had reached a point where they needed to exit because they had finished the investment period, which was 7 years. And at that point, they went to look for a strategic investor who could buy them out and leave the management part of the shareholding. They needed to sell out. And they went out, and we were able to get quite a number of institutions that were interested in buying their stake. The institutional shareholders owned 62%, 62.5%, and Tim Carson and James Mugambi owned, or myself, owned 33%. 37.5%. So into 100%. So that 62.5% are the ones who wanted to sell. And they went and were able to get quite some good offers. And the winning bid came from a company, a microfinance company from Botswana called Letseho. Letseho, which is predominantly a government payroll-based microfinance company. And Letseho, when they bought into us, the intention was for micro-Africa skills to be put across these institutions which they owned in other countries, which we have concentrated on very specific products. We have concentrated in individual business loans of up to 48 months. We have concentrated on group loans up to 12 months. We have concentrated on housing improvement loans, but for renters, not household, not for domestic or for occupation, but renters. People who are renting out houses, we help them improve them and increase the value that they are getting from the renters. And also, we have of late now introduced the short-term loans that are 1 month to up to 6 months that you can access at any one time without a lot of conditions, especially if you have been with us for a very long time. That spectrum of products takes care of people who are borrowing, say, ₦1 million and below, because of the speed at which we can process loans at, and the screening of the clients is not as rigorous, because the risk can easily be mitigated through various other social means like guarantors, referees, and having lived in one area for a long time. There are quite a number of other areas that checks that we make on clients that help us determine whether the client is viable for our funding. Because of our background in finance, we've got a very good feel of numbers. So it's easier for us to feel when the going is right and when the going is wrong. And we take hard decisions as and when we are sure that those decisions have to be taken. For instance, if you find that your product that you're offering is a loss-making product, we will work our ways around to make sure that none of our products is loss-making. And if it's loss-making, then we have to see how is it complementing the other business to make sure that it's being paid for indirectly. What do I mean? Group lending is very labor-intensive. Has to meet every week. A loan officer has to meet them where they are, meaning a lot of travel and many staff are needed to service the product. However, when we groom those clients, subsequently, they're the ones who turn out to become the SME loan officers, the loan clients, who at that point are taking bigger loans, requires less administration, meaning we invested in them 6 months ago, but now, a year down the line, they are taking loans. We don't have to follow them. We don't have to chase them around. So the cost of doing business with them becomes low as we progress. I'm passionate when I get committed into doing something. I give it my total self. I would say that I don't get driven by money. My drive comes out from achieving some very specific goals that creates impacts to more than myself. Like having started and having 220 members of staff today makes me feel very humbled in the sense that, for sure, this idea that Tim Carson and I conceived has come this far. This fast those are the kind of passions those are things that keep me running and saying, if I can do this, how much more can I do by working with more people and doing more? And I feel that there's so much more that can be done. And also the other one is when I go to the field and I meet people who are saying, telling me, thank you very much. If it wasn't for Premier doing this and this with me, I would not be this far. We've never been discouraged by failure. We have always asked ourselves, what is it that we can do? Because even in failure, there has been success. And we try and look at those successes and try and say, how can we scale up that success side of our business to what we can call now a business model?